starting our topic, planning. Once we have been able to identify all relevant risks in our client's operations, and we decide to do the audit, there's a need for us to plan the audit. So we are starting with planning today. Now we have what we call the audit plan. We have a document we call audit, that strategy documents. How you want to do the audits. ISA 200, already we all know that one to be what? Overall objectives of the independent auditor. That 200 is saying that we should be able to obtain reasonable assurance about ISA 200, overall objectives of the independent auditor. ISA 200 is saying that the objectives of the auditor is to obtain what? Reasonable assurance about what? Whether the financial statements as a whole are free from material mistake. Whether due to what? Fraud or error. And also to report on the financial statements and communicate as required by the ISAs in accordance with the auditor's findings. It continues to say that the auditor must comply with all international standards on auditing relevant to the audits. That is all the standards as far as auditing is concerned. And also to comply with relevant ethical requirements. And then you must also be able to plan and perform an audit with professional skepticism. Professional skepticism. Professional skepticism. Then exercise professional judgments in planning and performing an audit. And also to obtain sufficient and appropriate audit evidence to allow him to obtain reasonable what? Assurance. A starting point for audit plan is deciding which audit strategy to adopt. Last, we discussed about 4 audit strategies that we adopt in auditing. And they say that we have risk. The auditor will need to consider, among other things, audit risk, as we discussed already. There are so many audit risks that you must consider. Then we also have materiality. When they say materiality, that is what you consider to be material. Then the use he might make of computers. Yes. In planning, you must consider whether you're going to use computers and the effect that the client's computer-based system might have on his audit approach. So those things need to be considered in planning. Then we go to ISA 300. Now, planning and audit of financial statements. You are going to plan to audit financial statements. So, planning and audit of financial statements, which requires the auditor to plan the audit so that the audit work will be performed in what? An effective manner. An effective manner. An overall audit plan should be developed. After you have got audit strategy, then you have to plan the audit. That is what the overall audit now must be planned in such a way that detailing the expected scope of what? The audit and how audit should be conducted. The audit strategy is the broader framework within which the audit plans are deduced. So ISA 300 is saying that an audit should be planned so that it is performed effectively. Plan the audit in such a way that the work will be done what? Effectively. The auditor should establish an overall audit strategy. Already we discussed that already. That the audit strategy is the means by which the auditor, one of the strategies he adopts. It can be risk-based, it can be position statement, or it can be tentative procedure. Then the audit plan should include measures for the direction. That means within the plan, there should measures for direction, supervision, and review of audit work. That means the plan should cover what? Direction of the audits, supervision of the audits, and review of the audit work. Now, we have what we call audit strategy memorandum. That is the plan, the overall plan, audit what? Strategy memorandum. Most auditors prepare an audit strategy memorandum. Yes, that's a practical way of trying to find out how you want to do the audit. This is a document set out the main points involved in the planning process and the key planning decisions that have been taken. So in the planning memorandum, all the steps you want to take will be recorded, when it will be recorded, who is to do those jobs. The memorandum should be reviewed and approved by the audit engagement partner. As we discussed already, the audit engagement partner is the one who is going to sign that audit report. Is the most senior partner in the audit firm who is going to sign that audit report. Therefore, he should approve the audit memorandum. Then we also have memorandum will cover the following. So these are the areas that the memorandum should cover. The assignment objective and report to be issued. These areas will be covered in the memorandum. Then the audit timetable. The audit timetable must be required regarding the deadlines for the audit and the rest. Changes in the client's organization, if any. Then a summary of key financial ratios and other ratios from previous years. You need to consider all those things. Then planning decisions for audits. What is the planning decisions? The use that will be made of the client's staff. So you are going to work with the client. Client staff will be involved. The use you are going to make of them. The possible problems areas that you come across. You have already know the risk in the organization. So you know the areas that are having high risk, low risk, or medium risk. So the problem areas. Then the staffing requirements for the audit. Who are to do the audit? And who goes to where? So all these things are taken to the memorandum. They are all captured in the memorandum. Then attendance locations. That is if the audit is a very broad one, different locations may be there. Who audits Ghana a company? Who audits the Azerbaijan one and the rest? That is attendance locations. All these things should be captured. Then propose methods of communication with their clients. What are the means of communication? The proposed one. Okay. Information required to effectively plan an assignment. Yes. For you to plan do a very good plan, the information must be relevant. You must get that relevant information. Once you get that relevant information, you can do a proper plan. ISA 300, planning an audit of financial statement, requires the auditor to prepare an audit strategy and an audit plan. So, first of all, in planning, you must know the strategy you are going to adopt. Whether it is a risk-based, it's let's say a position statement method, or whichever strategy you want to adopt, or substantive testing, all this, or system-based. Whichever strategy, you must put it in place before you deduce the plan from the strategy. ISA 315, identify and assessing the risk of material misstatement through understanding the entity and its environment, requires that the auditor has sufficient understanding of the entity and its environment in order to understand the risks of material misstatements. What are we saying? It means that before you can undertake a very good job or do a very good job, have a good plan in place, You must what? Isaiah 315 is telling you that you must be somebody who understands your clients and then know the environment in which your client works. By this, if you know the environment your client works and you understand the risks, by that you will know the risks that are involved, various risks. If you don't know McDo's family, you may not know what are the risks we face as a family. Okay, so you must first of all know the environment in which I work. Then you understand me very well and plan appropriately. Non-relevant information. Yes, in the auditing, there are some information that are non-relevant. Remember that the objective of the audit is to identify whether material misstatement exists in the financial statement. That's the first thing. Therefore, information relating to immaterial matters or operational matters that will not assist in concluding whether a material misstatement exists in the financial statement may not be relevant. So in planning, irrelevant informations are not taken into consideration. Now, they say we must understand your clients and know, by knowing your clients very well, you also know the risks. And now we are coming to audit risk. Risk-based approach to auditing. Yes, once we know that audits we have different strategies, we are going to take one after the other. The audit will then design and implement appropriate responses to those risks. We said that for you to understand the client, you must, first of all, be able to be conversant with the client's operations. Once you know the operations, you identify the risks that your client faces. Then, after you have identified the risks that your client faces, you classify the risk in 3 or any other form. We have high risk, and then we have medium risk, and we have low risk. Then you plan in such a way that the planning should be able to respond to the overall risk you have assessed. So the auditor's responses to assess risks include. So in auditing examination, when they say your response, it means how do you plan to minimize the risk? What are your audit steps to minimize the risk? That is the response we are talking about. So your response should be assessed, that to assess risk include what? Including overall responses and the audit procedures responsive to the assessed risk of material misstatement at the assessment level. Now, irrespective of the assessed risk of material misstatement, the auditor shall design and perform substantive procedures for each material class of transaction, account balance, and disclosures. What they are saying here is that after you have known the risks or whatever it is, whether you are going to do risk-based, system-based, or whatever, you still perform substantive procedures. Substantive procedures are nothing but they are detailed testing of transactions and balances and disclosures. These are the procedures. The auditor shall also consider whether external confirmation procedures are to be performed as substantive audit procedures. What they are saying is that there are some information that are within your client's operations, but the informations came from outside the operations of your client. So there may be a need for you to confirm, and that is what we call external confirmations. External confirmation. A standard audit risk model is available to help auditors to identify and quantify the main elements making up overall audit risk. So what therefore is the audit risk? Audit risk is the risk, a chance that the auditor reaches an inappropriate conclusion on the area under audits. The audit process is designed to give a high level of assurance. Yes, it's true. We learned from the previous lessons that the audit risk, or what do you call it? The audit gives a high level of assurance. Therefore, your audit risk is the risk that the auditor will give inappropriate what? Opinion. The audit process is designed to give a high level of assurance about the information that is subject to audit, but not 100%. So audit, though it gives high level of assurance, it is not what? 100%. Now, if you look at the model on the board, we have risk, audit risk, which is a total. In some instances, the examiner can tell you what is a total risk. Total risk is the audit risk. This risk, which we call total risk, comprises of what? Inherent risk times what? Control risk times detention risk. All of them go into what we call the financial statement risk. All these risks, they all come into the what we call the financial statement risk. So all these risks, they form they come together to give us what we call audit risk. But all these three risks, two are not under the control of the auditor. For example, inherent risk is a risk which is automatic in the system that you are auditing. You have no control over it. It is by nature of the operations. Control risk are the risks that management put controls in place, but those risks may not be what? Working effectively. That is the control risk. So these two risks are not under the auditor's control. The auditor has control over what? Detention risk. It's under the control of the auditor. So meaning that you, the auditor, the only thing you can do to have an effective audit done is through the detention risk. So we want to know what is audit risk. Audit risk is the risk that items may be misstated as a result of their inherent characteristics. Inherent what? Characteristics. Okay? It is normal practice to assess inherent risk at two levels. Inherent risk, the level is one, the financial statement level, and the account balances and transactions level. These are the two levels of what? That we can use to assess the inherent risk. Control risk is the risk that a misstatement will not be prevented or detected by the internal control system, as I said already. It is a way that is the management put controls in place, but those controls may not be able to mitigate the risks, and therefore you have a risk, and that risk is called what? Control risk. Detention risk, on the other hand, is a risk that detention risk is the risk that the audit testing procedure will fail to detect a misstatement in a transaction or in an account balance. So this is the risk that is being controlled by the auditor. So it means that you can only manipulate the detention risks where you want to get more work done. That means you are going to do more work, and therefore you reduce the risk. Let's go to audit risk assessments. Summary, that's audit risk assessments. You could see that you have to achieve what? A larger level of what? Audit. That is, if inherent risk equals to what? Times control risk is high. Then you come to what? Detention risk must be low. What they are saying here is that if inherent risk times control risk is high, inherent risk in the operations of the organization is, let's say, high, and the control risk is also high, then you must what? Reduce your what? Substantive what? Risk. That's substantive risk. That's the detention risk, detention risk must be low. That means when you want detention risk to be low, that means you have to do more work. Then high level of what? Audit testing is required. So it means that to reduce what? The risk, where there is an inherent risk times control risk, and they are all high, it means that you have to do more work. That is the meaning of high level of what? Audit testing is required there. So where the risk is very low, they say inherent risk times control risk is very low. Then it means detection risk must be what? High. It means detection risk is also what? High already there. Then you do a lesser job in that area. Okay? The connection between risks, business risks, financial risk, and audit risk. You see, we have so many risks. We have business risk, financial statement risk, and audit risk. Therefore, we are going to know about the three of them. Business risk is any risk that threatens the ability of a business entity to achieve its objective. Every organization is established to achieve what? An objective. If you are not able to achieve your objective, meaning that you are facing some business risks. So business risk comprises of what? It's divided into two categories. A risk might have a low probability of happening. Yes. Or if an adverse event does occur, the resulting loss must be small. Okay. The next one is a business risk is an applicable risk when the financial impact of the risk could be high. For applicable risks, management should decide on a suitable what? Plan. So management should be able to put a plan in place to either reduce the risk, transfer the risk, avoid the risk, or accept the risk. So these are the four means by which risks are managed by management. The first strategy is that you can decide to reduce the risk by introducing more internal controls. Where you have a risk in an organization and the risk is in actual fact affecting the operations, to reduce the risk, it means you need to put internal controls in place. Very strong internal controls. Then you have reduced the risk. Another way of managing the risk is to transfer the risk. For example, you insure the risk with insurance company. That means you are transferring the risk from your end to the insurance company. You have transferred it. Or you can avoid it altogether by withdrawing from the business operations to which the risk relates. Yes, some operations have high risks. If you don't want to high risk, you don't want to involve yourself in those high risks, you can avoid it by not taking part in that particular operations. That is avoidance. Then accept the risk. Sometimes risks are inevitable, but some of the risks you can avoid them, some you can transfer them, and the others you can reduce them, and the rest you can accept it. That means whatever it is, you have to accept it as it is. So you can accept the risk and take no action to reduce it or transfer it. That is. Now, business risks and financial statement risks. Let's understand this very well. We are saying that understatement of bad debts or the allowance for a doubtful debts is one of the business risks. Then we also have overstating the value of inventory. If you overstate the value of the inventory, where net realizable value is less than cost, it means it is affecting the business financial statements. And then we also have overstating the value of a non-current assets. So in that sense, if you overstate an non-current asset, that means tangible or intangible, due to failure to recognize impairment. Some assets can get impaired, but once they get impaired, they reduce in value. If you don't take that reduction in value into consideration, it means it will affect your financial statements. We also, audit risk and financial statement risks. Business risk is a risk that management must deal with. Yes. Once you are going to start or engage in an operation, there are some risks that are prevalent in that organization. And that is the business we are talking about. Audit risk is a risk that faces the auditor. It is the risk that the auditor will give an inappropriate audit opinion when the financial statements are materially wrong or misstated. Audit risk follows on from financial statement risk. The auditor should therefore assess the financial statement risks as a step towards assessing the audit risk. What they are telling is that for you to reduce the audit risk, you must be able to assess your financial statement risks. When you are able to manage your financial statement risks, then you are reducing the audit risk. It is probable, however, that most of the audit risks will be identifiable as financial statement risk. It's true. Most of the risks that we call audit risk will affect the financial statement. Types of risk to consider include the following. Risk of overstatement of revenue. Where revenue has been inflated, in that case, it will affect the financial statement or any other income. Risk of overstatement of current assets. You overstate the current assets. It will also blow out the financial statement into a different thing. That means, risk of overstatement of current assets. Current assets are assets that do not go out. We don't depreciate them. So if you overstate the current assets instead of non-current assets, you see that the depreciation will be very small and it will affect the financial statement. The risk of overstatement of non-current assets is the vice versa there. Risk of understatement of liabilities. You have understated liabilities. Where the liabilities were 50 and you have made it 40. It means your financial statement will be what? Misstated. Risk of understatement of operating expenses. You have incurred operating expenses and you cut it. It will affect your financial statement. Risk from accounting estimates. Yes, in making accounting estimates, there is a risk. Instead of 20%, probably provision, you made a provision of what? 30%, 40%. It will affect the financial statement. Failure to comply with the requirement of specific accounting standards. Accounting standards are there to be followed in preparing the financial statement. If you fail to comply with the requirements, the financial statement will be what? Misstated. So we have this table, words of or phrase indicating a risk. So in the left-hand side, you have risks here. Then business risk indicated here. The business risks. Then we have financial statement risks. So each of them you have to take time and read them very, very well. Okay? Now, in planning audits, we need to take materiality into consideration. What, therefore, is material? The general principle is that International Audit Accounting Standard Board's framework for what? The preparation and presentation of financial statements state that information is material if its omission or misstatement could influence the economic decisions of users taken on the basis of the financial statement. What I say is that the users of financial statements in making decisions take so many things into consideration. So if the information can be their decision making can be changed because of a particular information, then that decision or what the information is material. Yes, if I plan going to Tamale, but something happened which will prevent me from going to Tamale, then it means that that information is material. So I have to take into consideration in planning. So I said 3 and 20, materiality in planning. So in planning, we look at materiality. Materiality in planning and performing an audit deal with the auditor's responsibility to apply the concept of materiality when planning and performing his audits. So what do they mean by this? It means that In planning, you must take materiality into consideration. Auditors do not depend on anything just because there are some that are material, which can affect the opinion. So we take materiality to consideration. The revised answer makes it clear that materiality depends on the size. So when they say something is material, it depends on what size and nature of an item judged in the surrounding circumstances. To McDo, 10 series may not be if I misplace my 10 series, it will not be so much material to me. But to somebody who is just a GSS boy or a girl, may, natural fact, 10 series getting he misplaced the 10 series, will be a blow to him. That day, he or she may not be able to eat. So it is the size and nature of item. What I mean by nature here is that there are some items that may even not have any value at all, may not be worth anything. But if you look at it, you fail it, it will to have an impact on your audit reports. For example, complying with what? Laws and regulation. You are supposed to comply with laws and regulation. If you fail to comply with laws and regulations, the consequences are so huge. The consequences are so huge. But there is no value attached to it. For example, the recent institutions cleanup, the banks cleanup. Yes, most of the banks fail to comply with laws and regulations. Compliance on those things does not cost too much, but because they failed, those banks are no more in existence. So they are saying that it is important to appreciate that the assessment of materiality is always based on the judgment of the auditor, applied to the circumstances of a particular case. So in assessment of materiality, it is the auditor's judgmental. So professional judgment, as we discussed previous, it factors here. So what is material and what is not material? So we have two types of materiality. We have quantitative materiality and then qualitative materiality. Quantitative materiality, those are the material items with values. It can be quantity, it can be anything. And then we also have materiality, which is by nature of like the law, as I said, compliance with the law. It has no value, but the nature of it, if you failed, it will have impact on the audit reports. Yeah, materiality should vary from one firm to another, but they will typically fall within the following ranges. So these are the ranges. So like revenue, between 1% to 2% may be a material item. So you can decide. So an item of revenue is material if it is at least 1% or 2% of annual sales revenue. So that is a material item. Pre-tax profits. Let's say before tax, that is pre-tax. 5%, between 5% and 10% can be considered to be material. Then we also have total assets. Your assets, a percentage times between 1% and 2% may be an item which we can consider to be material. So that is judgmental. Other factors that the auditor should consider in evaluating materiality may include the following. One, the nature of the item involved. Then, when they say the nature of the item involved, the valuation of some items in the financial statement are more subjective than others. In the financial statements, some are subjective, others are with specific value. Let's say provision for depreciation. It's a subjective materiality. Then we also have significance of the item. Some items may be insignificant in terms of their monetary amount, but may nevertheless be of a particular interest to users of financial statement. Yes, that's the law. Compliance with the law is one of the items. So probably in the financial statement, you don't see any value. Yet the users of financial statement want to see whether the company management are complying with those laws and regulations. The impact of the item on the view presented by the financial statement. Yes, the item on the view presented by the financial statement can be material or not. Those are some of the things. A small and apparently insignificant error or omission may be material if, by correcting it, it may have another effect. You know, a reported profit is converted into a reported to a loss. Instead of a profit, you have made it such a way that it becomes what? A loss. It may be material. Then the correction significantly alters the trend of profits. If you do corrections and those corrections change what? The profits, it is what? A material item. ISA 320, materiality in planning and performing an audit. Again, so in planning, we take materiality seriously. And I told you have two levels of materiality. We have two types of materiality. Two types are, one, quantitative materiality and qualitative materiality. Look at the materiality, whether it is a qualitative. In that sense, you are not looking at the value, but the effects on the financial statement or the users of financial statement. The effects. And then that is the nature. Then we also have the quantitative, which is the value placed on it. So when we're evaluating the effect of misstatement on the financial statement and therefore on his audit opinion. Yes, we are doing all these things because auditors don't do 100% job. We do sampling. So you have to find out how you are going to select your items for testing. Some of the items may be selected based on the nature of the item. Others also be selected based on what? The materiality threshold you have. So let's continue. At the planning stage, the auditor must determine materiality for the financial statement as a whole. So we have levels of materiality. Mind you, previously I say types of materiality. And I say types, we have quantitative materiality and qualitative materiality. Now we are coming to the levels of materiality. Levels of what? Materiality. So at the planning stage, the auditor must determine materiality for the financial statement as a whole. That is what we call what? Overall materiality, or materiality at the financial statement level. Overall materiality or materiality at the financial statement level. As the audit progresses, the auditor must revise materiality. So the materiality level you have set at the beginning may change as you start auditing or as you are in the progress of auditing. Things may come to light which may change overall materiality. If it becomes aware of information which will have caused him to have initially set different level, had that information been known to him at the time. So we have two levels of materiality. That's overall materiality level, and then we are coming to performance materiality. We have performance materiality, which we say that those are the materiality that we consider when you are performing the audit in various areas, the various circles. If you're auditing purchases or what we call procurement, the materiality level you set at the procurement level is different from the materiality level you set at what? Overall materiality. Then we go to what? Payroll. The materiality, you set a materiality. So those are what we call performance materiality. Okay? Yes, we consider materialities in computers in what? When you want to do audit and you are going to consider whether you should use computers in auditing. Yes. Sometimes your client is fully computerized. What do? So, or you yourself as an auditor, you want to use computer in auditing. So, computers in auditing. That's the next. Now, computer systems affect the audit process in two ways. So, as general principle, the computer system affect the auditor in two ways. Okay. The auditor may use computer to perform his audit assignments. You yourself can use your computer in auditing. That's one way. The client accounting system may be computer-based. That's another way. If your client is using computer to perform all the transactions, this is another way. The controls that are in play for the system and whether these are effective. So you have to consider whether you are going to use computer yourself, and when your clients are also using computer in preparing their informations, financial statement, and the rest, you have to consider that. Then, if that is the case, they are using, your client is using accounting system, the accounting system is computer based, then you have to find out the controls that are in place for the system. What are the controls my client put in place to mitigate what? The risk. You want to find out whether these risks or this the controls they put in the computer are effective. Oh, sorry. The next one, whether to use computer assisted audit techniques. We have called something CATs, computer assisted audit techniques. They are softwares or applications that we use in auditing. It is the auditors who use those softwares. So you can decide that, looking at my client system, it's computerized. So there is a need for me to use CATs. We call it CATs to do the audits. There are softwares you hook to your client system, which can give you an effective audit. Each of these should be considered at the planning stage. So at the planning stage, there are 4 elements here. 1, the auditor may use computer himself. 2, the client system may be computerized. Then, when those things are happening, that means you have to find out whether controls are put in place to mitigate the risks. Then, you can also use a computer-assisted audit techniques. Laptops may be used for tasks such as what? Laptops is not common. So we use laptop for what? Audit administration and control. We use laptop for what? Audit planning work. And then preparing audit working papers, analytical procedures if you want to do analysis, and then sampling software if you have it. Then controls over the auditor's computer systems. Yes. Controls should be placed to ensure that client data remains confidential and cannot be accessed by an authorized person. As part of the ethics of our profession, confidentiality is very important. Once you take some information from your client and put it on your computer system, make sure those informations are not accessed by an authorized person. Confidentiality is still there. So client data remains confidential and cannot be accessed by an authorized person. Those informations are not yours. They are for your clients. 2, audit work held on computer file cannot be lost. You make sure that the information you capture on the computer file or the computers cannot get lost, because they are not your information. Sometimes people put the computer and the backup, which we call pen drive, in one particular bag and travel with it. And when the bag is snatched from you, both your backup and the system is gone. So what is your information? An audit trail is rated for the work the auditor has done. So make sure that all the work you are doing, you create what? A trail to assist the audit review and control processes. In planning, all these things should be taken into consideration. And the programs operate in a way that they are expected. Make sure the program you're using they operate as expected. Then controls in computer-based information system. If you are going to audit a client that is computerized, you expect some controls to be in place. That's what we are looking for. So in a computer-based system, the internal controls will consist of both manual procedures and what? So we have what we call manual procedures. Yes, make sure that your client put in place manual procedure. The manual procedure, one of these, that is called general controls. General controls are controls over the environment in which the computerized information system is designed, developed, operated, and maintained. That is the general controls. That is why you go to many companies, the server room is not accessible by any stranger. It's strictly what? For those IT guys. Because that is the general control. And if you are staff and you want to go there for some one or two things, you need to sign a register so that they'll know the time that you have been in that office. And if you have tampered with any machine, they'll get to know. So meaning that general controls are the controls that your client put in place to make sure that informations captured are safe. Within the general controls, we have what we call development of computer-based information system and applications. How the software that they developed, how they are developed. There should be controls in place. One of the controls there is that the appropriate standards should be what? Established and enforced for designing, developing, programming, and documenting each new system. So there should be policies in place that before you develop a new information system, there should be what appropriate standards you need to follow. The suitable testing procedure should be in place. If they develop a new application system, but there is no suitable testing procedures, then it means the system may not be up to the standard they want. The design of a new system should be approved formally by management. Yes. If you go and you're auditing and they say they have put a system in place, but that system is not approved by management, then it's questionable. The next one is there should be a segregation of duties between a system designer and system testers. Yes. In computing, we have a programmer. A programmer should not act as operating staff because he understands the languages of the computer already. Therefore, he can easily go to the system and then change some command languages. And it happened to SSB some time ago. SSB. Is that not how you call it? No, it is SSB. Is it SS? The bank. SSB. No, SSB. There's a SSB. Is that one? The formerly it was SSB, but there's a name now, French name. So we are saying that it happened some time ago. The people, a programmer went to the system, changed the command language, and asked the computer to take coins, all coins on customer's account, and then deposit in a special account that was created by the programmer. So in actual fact, it is not a good idea for the programmer to act as an operating staff. Documentation and testing of program changes. For any change of a program need to be documented. Formal testing procedures should be applied for any change to a current program. So you can't change a program without a documentation. There should be a formal authorization. Yes, before you change any computer program, you are So that's it. There should be suitable staff training in making and testing program changes. So for you to change any computer program, there should be procedure. And the training, you should train the staff in such a way that they understand the new system very well. Then prevention or detection of unauthorized program changes. Yes, there should be a procedure for changing. But in case somebody wants to do it, there should be prevention in it. There should be a segregation of duty. That's one thing. If you segregate the duties, I don't think a programmer can just go. For example, there should be a segregation of duties between programmers and computer systems operators. Yes, I said it already. All program changes must be fully documented. The access to program files must be restricted. So you can't just go to any program file and start using it. There should be restriction on them. All these things are preventive measures. Okay. Make sure that what? Prevention of what? The use of incorrect programs or data files. So what they are saying is that see to it that data files and the rest are not changed. To prevent, then you have to prevent that. So there should be standard operating procedures should be established, and operations should be performed by suitably trained staff. For you to do an effective job, make sure that your client train the staff. If they fail to train the staff, means that they'll be doing anything. The scheduling of jobs for computer centers should specify the program files and data files to be used. The one who is using the sales ledger should not be the same fellow who should use what? The purchases ledger. So there should be segregation in all these areas. Review of operations should be what? Carried out regularly by management. Meaning that management must review the operations regularly. That is done, especially in big organizations. They have internal auditors who what? Carry out their reviews on behalf of management and report back to them. Prevention of unauthorized amendment to what? Data files. Data files should not be what? Changed anyhow. So they are saying there must be restricted access to data files. Limited to what? Authorized personnel. I told you already, the server rooms are restricted from people entering there, unless you are staff there. Transaction logs should be kept at all uses of what data files. So every transaction you are undertaking, there should be a log. Anybody who entered the system, there should be a system in place that this guy has come to operate this computer at this particular time. So there should be logs. Then ensuring continuity of operation. For you as let's say, management of an organization, that is what? Making sure that transactions go on. Make sure the continuity of your operation. In case of any disaster or unforeseen circumstances, the organization should still continue. You, the auditor, have to see to it that those things are in place. Secure backup copies. So when you are going to audit, find out if they have backup copies, and then program files and data files on those things. Measures should be implemented for protection of our equipment against fire. Yes, you go and you are auditing, and you go around. They don't have they don't protect the equipment from fire and the rest. So it means fire extinguishers and other firewalls should be put in place. Disaster recovery programs should be in place in the event of major disaster. So there should be a policy on disaster recovery programs, so that if disaster strikes, they can easily recover. Let's say, for example, controller and accountant general. There is a disaster, and all the servers in the computer now got bent or blew or whatever it is. What will happen if there is no disaster recovery program in place? It means all Ghanaians cannot be paid for 1 or 2 years, and you could see how the country will be. So they will put a disaster recovery program in place. Okay, there should be suitable maintenance and service agreements for all major externally acquired software. So if you make sure your clients have suitable agreement, that service agreement, with those who supply the equipment that they are using. So that is also application controls. So we have finished the hardware control, which we call general controls. Those are the controls put in place in the environment that the computer operates. Now let's come to the computer itself, which we call application control or software controls. It is also necessary for the auditor to identify and assess application controls in each specific computer-based application. Every software has its own controls, application controls there. So such as the inventory, receivables, and payroll systems. Inventory system may have its own control put in place. Receivables, like receiving money, there too there should be controls put in place. Payroll should have its own control system. The purpose of application control is to provide assurance that what is the purpose of assessing the computer system to see if there are controls? Is to enable you to be sure that the processed transactions have been properly what? Authorized. Yes, you want to see whether the transactions that they process are properly authorized. And then the processing of data is complete, accurate, and timely. So these are the main reasons for what? Now, control areas as far as the application is concerned. Inputs. There should be proper authorization for what? All inputs. You should be authorized to capture the information on the system. So data for input should be authorized before inputs. Data is input only by authorized person. So if you are on the sales ledger, you can be allowed to what? So if HR want to go and input sales information, it will not, the computer system should not allow him. That is the control measure there. Also, as far as completeness is concerned, make sure that document counts. There are document counts. How many documents have you processed? The system, there should be control in the system that can tell you that at any point that this particular transaction, 20 PVs were processed. Then control totals. As far as those transactions are concerned, this is the main total. Checking output to inputs. So you check the inputs as far as to what? Output. Review of output against what? Expected values, etc. These are all for completeness. As far as accuracy is concerned, you have to check to see check digits for key code items such as supplier codes, customer codes, etc. Then range checks. That is check on whether a particular value or figure is what? Feasible. That's why we say range 1 to 50. So within 1 up to 50, if there is a figure there, find out if it is correct. Then what? Existence check. A check on whether a particular code exists. So there should be check on what? Codes. Review and reconciliation of outputs. Then processing. As far as controls are concerned, area of control is processing. There should be checks that all input has been processed and that processing is what? Complete. Checks might include what? Control totals, bar totals, manual review, on-screen warning that processing is not complete. All those things are in the system. Make sure all those things are in the system. Master files and standing what? Data. What is a master file and what is a standing data? Management review of master files and standing data. So there should be regular management review of what? Master files and standing data. And then regular update of master files. Regular update of master files. Record counts. Now let me just explain what is master file. McDo is my name. From my primary school up to wherever I have reached now, my name is McDo. All information about me, my age, date of birth, my hometown, and the rest, they are captured against McDo. So all those informations go into what we call master file. But as to day-to-day transactions, today as I'm giving you this tutorial, it is what? It is a data I'm trying to bring out to you. So whatever you do every day or every time, that is what you call the standing data. Now, so they are saying that management should have regular update of master files. Make sure that if I change my name officially, then my name should change as again against the master file. Record counts, all those things need to be. Now, a very important area in planning as far as ICT is concerned is that if your client is using ICT, we call something COBIT, Control Objectives for Information and Related Technologies, COBIT. It's a system that is like a governance institution that every ICT operating organization should follow. So the existence of an accepted framework, such as COBIT, used for system development by a client, may provide additional assurance to the auditor in the assessment of the client's information system. What it means that if you are auditing Vodafone Ghana and they are complying with COBIT, it is an assurance to you that yes, once you see, COBIT is a what? Should I use the word? A system that almost all the information organizations should follow. So once they are complying with the COBIT, you are assured that the company is doing the right thing. COBIT consolidates and harmonizes standards from prominent global sources into a critical resource for what? Management control professionals and auditors. So it is normally what? These auditing, sorry, ICT organizations, they have to follow this COBIT. Once you go and they are following, they are complying with the COBIT what standards. At least it gives you an assurance that what they are doing is in conformity with what the standards say. So COBIT applies to enterprise-wide information system, including personal computers, mini computers, frameworks, distributed processing environment, etc. COBIT has been developed as largely generally applicable and accepted standard for what? Good information system, security and control practices that provide a reference framework for management, users and information system audit as well as what? Control and security practitioners. So it is a framework which in actual fact is practiced all over the world. Once your client is complying with the COBIT framework, at least it gives you the comfort that they are doing the right thing. The purpose of COBIT. Why COBIT? Why? It's like audit standard. Why auditing standard? It's the same thing. The purpose of COBIT is to provide management and business process owners with an information technology governance model that helps in understanding and managing the risk associated with IT. So it's a framework, like the accountants. If you are an accountant, you don't want to follow the accounting standards. I don't know what you are, or framework. I don't know what you are going to use. So COBIT helps to bridge the gaps between business risks, control needs, and technical issues. It is a control model to meet the needs of IT governance and ensure the integrity of information system. Users of what? COBIT. COBIT is used by those who have the primary responsibility for business processes and technology. Business what? Process. So management is inclusive. Okay. Those who depend on technology for development, for relevant, and reliable information, as well as those providing quality, reliable, and control of information. So if you are auditing ICT company or company that is what? ICT bias, make sure they follow the COBIT. Once they are following the COBIT, it gives you an assurance that at least they are doing a good job. Application of COBIT in business processes. So how do you apply it? COBIT is a business process oriented and therefore addressing itself in what? The first place to the owners of these processes. COBIT provides the business process owners with a framework which should enable them to control all the different activities underlying IT development. This allowed self-assessment in order to make choices for control implementation and improvement over IT, measure the achievement of goals and the proper performance of IT processes. COBIT components. As for every system has components. Every system has components. Like auditing standards, they have components. Those that relate to what? Assurance engagement. Those that relate to quality control. Those that relate to non-assurance jobs and the rest. The tools are performance measurement elements. That's one. The second one is a list of critical success factors that provides what? Stringent, non-technical best practice for each item process, maturity models, and the rest, and the rest, and the rest. Now, COBIT comprises 6 specific components. There are components in the COBIT that they need to follow. The first one is management guidelines. Management guidelines. There should be guidelines for every IT system in what? In the organization. Then you have executive summary, framework, control objectives, audit guidelines, and implementation tool. Like the way ISA is what? Developed. It's the same thing in this regard. Now they explain them what we mean by management guidelines. And they say management guidelines are composed of what? Maturity models to help determine the stages and expectation levels of our control. Then we have critical success factors to identify the most important actions for achieving control over the IT processes. We have key goal indicators to define target levels of performance. And we also have what? And key performance indicators to measure whether an IT control process is meeting its objectives. So these are the 3 management guidelines. The first one is maturity models, the critical success factors, and then key goal indicators. These management guidelines will help answer the questions of immediate concern to all those who have a stake in enterprise success. Now, about executive summary too, they told you that sound business decisions are based on what? Timely, relevant, and concise what? Information. Specifically designed for time-pressed senior executives and managers. COBIT includes an executive overview, which provides thorough awareness and understanding of COBIT's key concepts and principles. So these are some of the framework itself. A successful organization is built on a solid framework of data and information. The framework explains how IT processes deliver the information that the business requires to achieve its objectives. This delivery is controlled through 24 high-level control objectives, one for each IT process, containing the 4 domains, which we said already. The framework identifies which of the 7 information criteria, as well as what? Which IT resources are important for the IT processes to fully support the business objectives. Control objectives. So they are just trying to elaborate all the framework that we discussed. The key to maintaining profitability is a technology changing environment in a technology changing environment is how well control is maintained. So COBIT control objectives provide the critical insight needed to delineate a clear policy and good practice for information technology controls. So those are then included are the statements of desire, results, or purposes to be achieved by implementing the specific and detailed control objective throughout the 24 information technology process. Then audit guidelines. What are the audit guidelines? To achieve desired goals and objectives, one has to constantly and consistently audit one's procedures. Means that once the management puts all those systems in place, they need to what? Make sure they are audited. And the audit guidelines outline and suggest actual activity to be what? Performed corresponding to each of the 24 high-level IT control objectives, while substantiating the risk of control objectives not being what? Met. Audit guidelines are an invaluable what? Tool for what? Information system auditors in providing management assurance or advice for what? Improvements. Then, now that you have got your what? They shall be audited and some areas have been identified as what? Not working well. How do you implement? So implementation 2. The implementation 2 set contains what? Management awareness and IT control diagnosis. So management awareness. The implementation guide, that's FAQs. Yes. The case studies from organizations currently using COVID. And then slide presentations that can be used to introduce COVID into system organizations. Now, you have microcomputers, online systems, and EDI, that's electronic data interchange, which you need to know them one after the other. The following types of system may require special attention by the auditor. So you, the auditor, must also know what is a microcomputer system, and the online system, and electronic data interchange. These are things that you have to know if your client is operating ICT. What is microcomputer system? Microcomputer system is not precisely defined in terms. Yes, it's true. But it refers to a computer system in which the entity uses a number of standalone desktop computers that are located throughout the organization. You go to some organizations, there are so many tables there with so many computers on there. So in that case, they are practicing what we call microcomputer systems. The auditor may have some difficulty. In that system, the auditor may have some difficulty, however, in satisfying himself that the controls for the system are sufficient and effective. Yes, since everybody is using personal computers, you see that the controls, to be sure of the controls, you have to go through all the system, which is very difficult. So they are saying that that is the problem you, the auditors, face. The problem for the auditor in checking the effectiveness of controls happen for the following reasons. Why? In the microcomputer systems, because almost everybody in the organization is using PC. Now, if you want to check the effectiveness of the controls, for the following reasons, it will be difficult for you. One, the difficulty of ensuring adequate physical security of the equipment. Everybody, when they close, some of them even take the laptop home. Some of them, you keep it there, securities will be watching and so forth. Whether if somebody comes early and then go into the system and the rest. So these are the problems. The second one is difficulty with ensuring the security of the data. Yes, and storage media. The data captured in those pieces. What is the security there? So that is your concern as an auditor. Then the auditor should want to see adequate documentation of the software system. Yes, the software system they are using, you want to see the way. It is your duty to check. So those are the problems. Then we also have online systems. Online system, which you call integrated. That's online system are network computer system that allow users direct access to centrally held data and programs. Access to the central file is through remote terminals. All the workers, they have a server, or they have a software which enable all of them hook into the system. So they are not doing it on one-on-one basis. Online systems offer a number of operational advantages to entities that use them. Yes. You can also hook, if you are from outside and you want to go into the system, you can easily go. And it has operational advantages. They permit the immediate entry of transactions. Yes. If you want to admission at, let's say, Lagos, and they say you should go to so and so, and then you log on, it immediately you see that the transaction is processed. So they permit immediate entry of transaction from what? Many different locations. Somebody is also at Upper East region. He also key. So different people from different locations or with different transactions are processed at the same time. In the same way, Centralized master files, such as master files for inventory, are updated immediately. Yes, in this system, they have what you call centralized master files. And they say, example is what? Master file for inventory. So anybody that wants to know to any transaction as far as inventory is concerned, the fellow can process it. Whether you are in Bolga, you are in Wa, you are in Tumu, or wherever, Accra, Somanya, all of you can use the same system and it will work. And they are immediately updated. The stock figure will be immediately updated because it is online. Online system allow users to make inquiries and obtain immediate responses. Yes, you can find out, you can make inquiries and the results will come to you by having access to master files or reference files. There should be sufficient general controls and application controls to minimize the risk that arise from what? Using online systems. You see? Yes. So as an auditor, your duty is to find out if there are sufficient controls in place to minimize the risks that arise from using online systems. So we have general controls in an online system, which include what? There must be, you must find out and make sure that there is effective control over access to the system and its files. Make sure there is a control in that line. There should be controls written into the system software to prevent or dictate unauthorized changes to programs. Since the system is open to everybody, it means that there should be the controls into the system software, which can prevent or dictate unauthorized changes to programs. Nobody should pass through the system and change any program. Okay? Transaction logs should be used to create an audit trail. Whoever goes to the system at any particular time should be trailed, meaning that there should be audit trail. It should be noticed. So the time the fellow went to the system, what the fellow did, and the time taken there, and so forth. An audit trail refers to the ability of the auditor to trace a transaction through all its processing stages. That's the audit trail. Any means by which the auditor will be able to know all the transactions that went on within and the time that it went on and whatever it is for should be noticed. Firewalls should be used for systems that have access to internet. They are saying if your client is using internet, then you need to check whether they have a firewalls in place. Firewalls are hardware or software devices that prevent unauthorized access to a system from an internet user. So it is also a control system measure. So make sure they have a firewalls in place. Now let's come to application controls in online. Now we have the general controls. Let's come to application control, the software controls. Pre-processing authorization. Before somebody process any transaction, it should be pre-auditing. That means pre-processing authorization, such as logging on to the system and the use of usernames and passwords. That's where passwords, usernames should be in. Then data validation checks in the software to check the completeness and accuracy of processing. There should be a control in the system in such a way that all data should be validated and all software need to be, and there should be check on completeness and accuracy. Then balancing, checking control totals of data submitted from remote terminals before and after processing. So all these things, it is your duty as an auditor to check and see whether they have controls in place. These things are in place if your client is using IT system. All right. Now let's explain what is electronic data interchange, EDI. Electronic data interchange systems are systems that allow the electronic transmission of business documents, such as invoices or payroll information between different computer systems. What does it mean? It means that a company A may be using a different application. Another company B may be using another one. So all these people, for them to speak a common language, they should have what we call EDI in place. EDI is it's like if you go to court, somebody from North speak Dagbani, and the judge doesn't understand Dagbani. They will ask for interpreter. So in this case, EDI serves as what? An interpreter to the system. The application software used by company A cannot be accessed easily by company B. So there should be what? Interpreter in between the two of them so that they can access. The EDI system provides a form of what? Translation service so that the data transmitted from one computer system is changed into a form that can be read by the other computer system without any need for human intervention. So it serves as what? A translator. EDI system improve the operational efficiency of an entity, but they may generate the following problems for auditor who has to assess the efficiency of the system control. Yes, we say EDI is very good. They translate from one particular application to another application. But the problem is this. They lack what? A paper audit trail. That's the disadvantage. And then they also an increased level of what? Dependency on the computer system of what? The organization and possibly the computer system of other entities. So it's a disadvantage. You are depending on the what? Computer system. And then there may be a risk of loss or corruption of data in the process of transmission. Yes. If the translator is translate somebody's speech into another language, you see, he may not speak this exact words. He may not use exact words that the original speaker has used. So there may be loss of data in the transmission. Yes. Once this EDI is translating one software into another software, along the line there may be what? A loss of data. That's what you are saying. Then there will be security risk in the transmission of data. Yes. Once you are transmitting the data online, it means that it can also, there is a risk that somebody or there can be a problem in the transmission. What is the effective control in place? So make sure that there is an effective control in place to minimize the risk inherent in the systems. What are the effective controls you are expecting? Control over the transmission of data. Make sure there is a proper control over the transmission of data. The second one is make sure the monitoring and checking of output are done regularly and it's very effective. Then virus protection system. Yes. And you know, the one who brought us good news, they brought the virus. Those who brought the computer and the softwares, they are the very people who produce or provide what? Viruses. Viruses can also be another. So virus protection should also be there, put in place. Contingency plans and backup arrangement should also be put in place. What is CAT? CAT, Computer Assisted Audit Techniques. These are the softwares that are used by the what? The auditor. CAT are often necessary in the audit of computer-based information system because this system may not provide an adequate audit trail. So CATs are the computer assisted audit technique. They are software that are used by what? Auditors. They involve the use of what? Computer techniques by the auditor to obtain audit evidence. And then in addition, processing is invisible because it is electronic. So we need to use CATs in our auditing process because it is a software that can interrogate our client system and be able to tell us what happens there. Then, in addition, processing is invisible because we cannot see the processing. Once information are inputted into the system, the processing cannot be seen. Therefore, we need to use CAT because it is electronic. Two commonly used types of CAT are, we have two main types of CATs. Example, they are saying audit software and test data. What is audit software? So, audit software is computer programs used by the auditor to extract information from a client's computer system information for use in the audits. So you extract information from that. The audit software. It's an application. It's a software we use to what? Extract information from your client system, because your client is using what? Software. So you need to extract the information by using what? CATs. The next one is what? Now the main types of software include what? Interrogation programs to access the client files and records and extract data for auditing. The interactive software. We also have resident code. Let's see what is interactive software. Interactive software for use in interrogation of online computer system. Now, if you are using the online, your client is using online system, then you need interactive software. But resident code or embedded software, which is to monitor and review transactions as they are being processed by the client programs. This type of software is called embedded audit facilities. They are facilities that are hooked to the client software. As they are working, then the software will also be extracting information from the system for the auditor. The main use of audit software is in substantive audit testing. All right? What is test data? An auditor may use test data to process what? A sample of transactions through the client's computer-based information system and compare the results obtained from the processing with what? The predetermined result that the auditor will expect. Test data is used primarily for tests of controls. So what they say is that test data is that you know that 1 + 1 is 2. That is the predetermined what? Result. We know already is 2. So you intentionally put 1 + 2 into the system to see that if the system can give you what? The answer 2. So you are testing. If the system gives you a different answer from 2, then the system, the controls are not properly built in the system. If it gives you 2, like Excel, 1 + 1, the moment you say 1 + 1, it will take out 2 straightforward. So every software has their own controls. Word has their own controls, which if you type Kofi in the, on the computer system, and the computer does not have that Kofi in its dictionary, it will underline it for you. Or it will give you another alternative, the spelling of that Kofi. That's what you call test data. CATs should only be used in the benefit if the benefit from their use exceeds the cost. So they are saying that yes, it's a software we use as auditors, but as far as disadvantage is concerned, it can only be used if the benefits exceed the cost. Cost benefit analysis. You have to do that before you use the CAT. You don't just go and buy a software which is about, let's say, 10,000 and the benefit is about 2,000. No sensible businessman can do that. So they are saying the cost related to the use of CAT may include what? Purchasing or developing the program. So if you want to use a CAT or software, you can purchase it on the shelves, or you develop the program yourself, or you engage a programmer to develop it for you. Then keeping the program up to date for changes in hardware and software. Yes, it's also another cost. Then training audit staff in their use. We don't just buy the edition without training the staff. The staff need to use it well. So proper training of the staff is also a cost. Obtaining time on the client's computer system to run the CATs. Yes, when you go to your client, you are going to ask them to give you their system so that you can use your software to interrogate. But how? The time that will be spent by you in extracting those from your client, and the client will also be wasting time waiting for you to do all those things. It's a cost. They give advantages of CATs. Yes. Every good thing has an advantage. Therefore, they say they give auditors an ability to test the completeness and accuracy of electronic processing itself. So rather than relying only on testing the accuracy and completeness of inputs and outputs. It is when you are using the SCAT, the software, it gives you more information and then give you accuracy and everything, and it gives you completeness and everything in the system instead of relying on inputs and outputs, which we call what? Auditing around the computer, which is no more existing in Ghana anyway. They give the auditor an ability to test a larger number of what? Yes. Have a computer, any number, you can load it to the system. It will work it for you. Then they allow the auditor to test what? The effectiveness of control that are programmed into the computer. Yes, you are not somebody who can check the computer inside the computer, but by using the software, you can find out if the controls are effective there. Now, we have come to not-for-profit organizations like NGOs. They are not what? Profit-making organizations. Let's say University of Ghana is not NGO, but it's a government institution. The purpose is not to make profit. So, not-for-profit organizations, how to audit them? Audit is an audit, irrespective of where you are doing it. Whether you are doing it in the bush, under the ground, or in the air, it is an audit. So, auditing of not-for-profit organizations. In any audit or review, it is important to understand the entity and its environment. So, audit is an audit. So, whatever we discuss about auditing from beginning up to now, how to plan the audit, it's audit. So, what they are saying is that as far as it's an NGO, you should understand what? The environment in which that NGO or that non-profit making organization operates. A key aspect of an audit or review may be the objective that the entity is carrying to achieve. So the most important thing you have to learn is that what is the objective of that particular organization, non-profit organization you are what? Auditing. So you should know what is their objective. Are they meeting it? In commercial, then you have to achieve, probably in commercial organization, the objective is to make profit. Yes. For the shareholders. We know. But in the NGO, who are the owners? In the case of not-for-profit organizations, the objective is very different. So it differs from organization to organization. If you go to some NGOs, they are for education. Other NGOs are for what? Medicals, or what we call health. Other NGOs are for just helping needs of the people and so forth and so forth. So the service provided by not-for-profit organization will have to be provided within the constraints of the resources it has at its disposal. So make sure that those NGOs, or what we call not-for-profit organizations, they operate within the resources they have. Now the audit approach, as I told you already, the auditor should recognize the specific features of the not-for-profit organization. However, it is important to realize that the audit is still performing an audit. So the auditor is still performing an audit. Once you are doing audit, it's an audit. And the overall structure of the audit of not-for-profit organization will be similar to the audit of commercial organizations. So there's no need going so far down. Now they are telling you that, yes, the main point you have to bear in mind with the audit of a not-for-profit organizations are, one, you have to plan the audits. You have to know the risks. You have to check the internal controls. Then you must obtain audit evidence. Then you must report on them. So this is the summary of what? Not-for-profit organization. But don't forget, other factors also come in here. Other factors which you need to consider include cash may be insignificant in small not-for-profit organizations, and controls are likely to be what? Limited. Yes. So find all those things are there. Income could be risk area. There may be limitation on the scope of the audit if obtaining audit evidence is a problem, and so forth and so forth. Thank you very much.